Ad van Tiggelen, Senior Investment Specialist in ING Investment Management, joins me now live from The Hague. Ad, good morning. Thanks for joining us.
Good morning, Mark.
The Federal Reserve's Economic Symposium at Jackson Hole, I mean, have you changed your assessment at all on global equity markets in light of everything that was said this weekend in Jackson Hole?
No, not at all, Mark. We are at the moment neutrally invested in equities and neutral weighting versus bonds. That means that we think that markets are fairly priced right now. Jackson Hole brought nothing new. Basically, Bernanke did what he was supposed to do by extending quantitative easing and keeping interest rates lower for longer. I think that was what the market expected. That was what the market needed. But nothing new under the sun in that sense.
So do you think that this rally that we've witnessed since Bernanke announced what he could do if he needs to do it, do you think this rally might be short-lived?
Yes, I don't see any need for an extension, for a strong extension of that rally right now. The earnings season is behind us. That was very good. Markets are now focusing on the third quarter, on the potential of a double dip. Which has a chance of happening. We think it has a realistic chance, but it's not our central scenario at the moment. Therefore, we are neutrally weighted in equities. There's no need right now for markets to really have a strong rally just on this news, which was a confirmation of what was already expected.
I mean, you're looking at basically at a new normal, almost a new paradigm, a new reality. You know, you cite an aging society. If you add to that a financial shock, you say ultimately we've got a very low growth environment and deflation risks. I mean, it's not an ideal environment, is it, for stock investors?
No, it's a modeling through environment in which you should focus basically on high dividend stocks, stocks which create a good income. The problem is that we don't think that in the second phase of the recovery, which we are now approaching, that the consumer will take over from the manufacturing side of the economy. Until now, if you look at the US, for example, at the last 4 quarters, you had about 3% growth. And around 60% of that 3%, 1.8, was purely inventory rebuild. That inventory rebuild will die down and will have to be replaced by a pickup in consumer spending. And that's something we do not expect. We do not see much reason for consumers in the present environment with little loan growth, still high employment, uncertainty about pension going forward, to really start consuming more.
Ad, thanks for joining us today. We'll chat to you soon. Ad van Tiggelen, their Senior Investments.